All right, Chris, I think it's you that's worried about if this is an oncoming train.
Well, our point was just we really don't know what's going to happen. A lot of the optimism that we've seen so far could be warranted based on all the stimulus we got from the Federal Reserve as well as from the federal government. However, we don't know if there's another shoe to drop later this year if the virus does have a resurgence. So we're just cautious, making sure that we're playing it both ways. You want to be taking risk and being optimistic about what may happen in the future in terms of the recovery. However, you've got to be careful that this could be a prolonged recession because we may get a resurgence later on this year, and we have to prepare for both cases.
Darrell, it's interesting to look at the CNBC Fed survey where, people expect another $3 trillion coming from the Fed and $2 trillion coming from Congress. And even so, the economy not back to what it was until mid-2022. Does that mean that people are too pessimistic or that the stock market is too optimistic?
I think probably the latter right now, Kelly. We tend to think, along with Chris, that equities look a little bit overextended here. We're watching very closely. I mean, if you use earnings numbers and look through even 2020, the 2021 consensus right now are for $169 on S&P earnings, which is certainly above the 164 prior peak in 2019. On average, it takes markets usually about 3 to 4 years to recoup those high earnings watermarks. And I think there's a lot of anticipation and positive news about the reopening of the economy right now. One of the things that's been talked about quite a bit, and I think is material here as well, is a big piece of this retracement rally has come through a very narrow breadth. We talk about the top 3, the top 5, the top 9 driving this. If you look at the bottom 250 to 300 names in the S&P 500, a lot of them have not participated well in this retracement rally. So we'd like to see equities calm down here a little bit. If you look at what the bond market's telling you, what the commodity markets are telling you, and what the FX markets are telling you, none of them are particularly flashing great signals and signs right now.
Right. Although, Chris, as I heard, I think Kyle Bass say this morning, you have the Federal Reserve in there to support every aspect of the economy except buying stocks outright. And so obviously the market is rallying because they're supporting risk assets of all kinds, even if they don't extend those purchases to equities yet, right?
That's true. You're back to the TINA trade. There is no alternative. And I think part of what the Fed is doing by easing financial conditions is providing a scenario where it's very hard to stay in cash. You still probably want to have bonds as part of your portfolio. But ultimately, risk assets are the place to be. And when the Fed floods the market with liquidity, you get the kind of rallies that we've gotten so far. Now, ultimately, liquidity can only take you so far if the fundamentals don't keep pace with what the markets are expecting. That's where you can have some trouble, and I think that's where we agree with what's been said so far, which is that you have to be cautious. It's not a time to take drastic action, but trading up in quality, looking for better companies with better balance sheets, having the wherewithal to make it through a recession that could be potentially protracted, even if this is shorter, like we all hope.
No, you're not one of the kinds who's buying energy, I see, or materials or industrials, or at least the kind of heavily leveraged plays there. Darrell, would you be looking in some of those aspects like, the traditional investing wisdom goes? You kind of want to buy what everybody's hating, typically, right?
That's true, Kelly, and perhaps over the long term. But right now, while we're in the midst of a recession, we would still be underweight industrials, energy, materials. We would actually be overweight technology, consumer discretionary, healthcare, and some financials as well. We think those are your better up quality fortress balance sheets that when the economy turns back on can give you some defensive names. Maybe the exception there is financials, which have really taken it pretty hard.
Yeah.
The reality is, though, when they're trading at, half of tangible books, when you're getting the dividend yield, we still think that's a nice value play here at today's levels.
Darrell, one final quick question. You mentioned that you're overweight technology because of the fortress balance sheets. Would anything in earnings this week change your mind?
No, I don't think so. Because, again, I think you'll probably see decent earnings numbers. That's been the theme so far over the last day or two. But if you look at the broad season, Kelly, we came in, right now we're down about 24% year over year on Q1 earnings. That's 9% below consensus heading into the season. The tech companies will continue to lead. They have the best demand and sales growth or revenue growth on the top side. we expect that trend to continue.
Okay.
So I think you've got to stay long technology here.
Yeah, I'm just curious because, again, with the ad declines, we're going to talk about that a little bit later on for Facebook and Google. They're certainly not immune, but as you're saying, there's other reasons to like them. Thank you both, Darrell, Cronk, Chris Zaccarelli. Appreciate it.